friends and welcome to Kirti Rane classes. In today's video, we are moving on to our next point, which is objectives of financial management. If you want the explanation of this exact same point in Hindi, please check out my channel playlist. You will find another video with the same topic explained in Hindi by me. So let us get started with today's topic, which is objectives of financial management. So let us get started. The objectives of financial management dictate every decision a business makes regarding its money. These objectives are generally divided into two main categories, which are core primary objectives, which is often spark a classic debate in business theory, and operational secondary objectives. So in the introduction of this topic, we got to know that the objectives of financial management are divided into two main categories. First of the main primary objective and second are the secondary objectives, which are listed over here. So the two main primary objectives are the profit maximization, which is the traditional way, and the second is the wealth maximization, which is the modern view over the financial management. The next is the operational and secondary objectives. We will be viewing all of these objectives in detail in the further slides. So before we move on, please take a screenshot of this slide so you can take notes while watching this video. Moving on to our next slide, we will be starting with the two main primary methods or objectives of the financial management. So in financial theory, there is a fundamental shift in how businesses view their ultimate goal. This forms the basis of two primary objectives. We will start with the first objective, which is profit maximization objective. It is also known as the traditional method. So what does profit maximization objective state? It says that historically the main goal of any business was simple: make as much profit as possible. Under this objective, all financial actions are evaluated based on whether they increase the total profit or earning per share. So the profit maximization objective is also the traditional method in which we take into viewpoint the core objective or the core goal, which is earning as much as profit as possible. But why it is known as the traditional method or why it is not considered in the modern view, we will be viewing on in our next slide. Okay, so before that I would like to summarize this point, which is that the profit maximization means to earn as much as profit as possible, that is increase the number of quantity of profit or earning per share. Now please take a screenshot of this slide so we can move on to the next slide to know why profit maximization is important and what are its limitations. Now, why does it make sense? Why does the profit maximization objective actually make sense? So, the profit is the test of economic efficiency, the source of funds for growth, and the primary measure of business success. Traditionally, from way back, whenever if we want to view the success of any business, we would measure its profit. Now, while measuring its profit, we will say that this business is economically stable, it is a really big business, etc. Only on the basis of the amount of profit it earns, right? So that's why the profit maximization objective would make sense in the previous days, in the traditional days, in the olden days, okay? But now, why does it not make sense? We will be viewing at its objective. Limitations. So the limitation, it is a short-term approach. It ignores the time value of the money. That is, for example, receiving $10,000 today would be better than receiving $10,000, let's say 5 years in the future. Like similarly, if we have seen that our grandfather sold their land for 500 rupees, but at that time it was equivalent to more than a lakh or 2 lakh rupees. But so that time the 500 rupees is of a much greater value than of today. Therefore, profit maximization will not consider the amount of inflation generated in the economy. That is, the time value of money is not considered in this objective. Now, it also ignores the risk and uncertainty. A high profit project might incredibly dangerous for a company's survival. We say that without taking risk, you cannot generate profit or cannot achieve success. But similarly, if you get a high profit project, but it may pose a danger for a company's survival, you might not take it. But if you are working solely on the profit maximization objective, it will pose a danger for the survival of the business. Okay. So these are the two limitations because of which why the profit maximization objective is not much popular in today's financial management view. Moving on, before we move on to the next slide to view the wealth maximization objective, please take a screenshot of this slide. Now moving on to the next slide, which is the wealth maximization objective, which is the modern view of the financial management objectives. Now let us see what does it mean. The modern approach argues that the ultimate goal should be maximizing the net present worth of the business, which translates to maximizing the market value of a company's share. So what does the wealth maximization objective actually mean? It means the increasing the value of the company in the market, right? We can say that a company is earning a much higher profit, but we cannot say that its value has been also been increasing tenfold, right? So when we focus on increasing the core fundamental value of any business, we focus on the wealth maximization. Wealth will keep on for the generations, will stay there for the generations, and profit would be there for only a short period of time. Therefore, the wealth maximization objective focuses on increasing the value of the business in the market. Now, let us view why is it so superior. So, wealth maximization is a long-term goal. It takes into account the time value of the money, the risk involved, and the stream of returns over time. Now, if we take a look at the profit maximization objective, it did not take in the account of the time value of money or the risk involved. It would only see that this project will earn me a higher profit, that's why I should do it. But wealth maximization, it will see how much time do we have to invest in it, how much risk would the business have to incur while taking on this project. Will it pose a harm for the survival of the business, or is it has a much greater risk? So, viewing all these points, the wealth maximization objective will take a decision to continue that project or not, unlike the profit maximization objective. That's why wealth maximization objective is termed to be superior than profit maximization. Now, what are its outcome? What outcome do we receive by the wealth maximization objective? If a company's share price rises because of good financial decisions, the wealth of the owners or the shareholder increases. Today, this is widely accepted as the ultimate goal of financial management. Now, in today's world, if we want to see what is the wealth of a business or how does it earn, right? We will view at its share price or the share market price. If it is increasing because of some financial decision the business took, it means there is an increase in the wealth of the shareholder or the owners of the company, right? So in today's world, this wealth maximization concept is really important while viewing from the financial management view. Therefore, it is the main and the modern view of the objectives of financial management. So please take a screenshot so we can view all the operational and the secondary objectives of financial management. So let's move on to the second main topic, which is the operational or secondary objective of any financial management. Now, to achieve long-term wealth maximization, a financial manager must balance several daily operational goals, right? So there are few operational goals listed and we will be viewing them one by one. So first goal is ensuring regular availability of funds. A business must have adequate funds for both long-term growth and daily operations. Running out of money halts production and damages credibility. Now, what does this point is trying to say? It says that a business should manage its finance so that it has money or funds for both the long-term objectives and the day-to-day uses. In short, the working capital and the investment capital, right? The investment, the mean long-term fixed capital and the working capital. Working capital for day-to-day use like salary, daily wages, and let's say short-term loan creditors, right? So it should have the money for day-to-day daily objectives as well as the long-term objectives like buying a machinery, expanding the plant, promoting the business, etc. Right? The long-term objectives or the cost. So it says that if you do not have money for the short-term objectives, you may not have your credibility would be lost and your business would not continue because you cannot pay for your day-to-day objectives or day-to-day expenses. Therefore, the keeping and balance between the long-term finance and the short-term finance is very, very important. Moving on to our next point, which is the safety of funds. Now, what does this point is trying to say is the speculation is risky. Funds should be invested in safe, viable ventures where the risk of losing the core capital is minimized, ensuring the stable financial base. It states that the funds should not be blindly invested into anything. It should be invested after considering the return it would generate, whether the funds would be completely lost if the plan goes to fail, right? So it says that we should safely, by thinking, we should invest the funds safely, right? And we should ensure that the core capital invested, we would be able to at least get a return out of that, and if possible, more profit out of that investment. So this is what the second point, the safety of funds, trying to say. So before we move on to more points, please take a screenshot of this slide. Moving on to the third secondary objective is the maintaining optimum liquidity. Now, what does maintaining optimum liquidity trying to tell us? It tells us that liquidity is the ability to meet short-term financial commitments like paying suppliers, wages, bills, etc. on time. There must be a healthy balance. Too little cash leads to default, while too much idle cash earns no return. So what is this point trying to say? In the first point, we saw that we need to keep liquidity in the business for our day-to-day operations. But we need to maintain an optimum liquidity. We cannot, let's say, keep too little of the money that we cannot meet our daily day-to-day expenses, and we should not keep too much of the liquidity or the daily money so that it would remain idle, right? Idle money is of no use. So a business should invest their money optimally. So they should ensure that there is an optimum level of liquidity in the business for day-to-day expenses, as well as no money should sit idly. Okay, so this was the third point or the third type of secondary objective. Now moving on to the fourth type of secondary objective, which is ensuring fair returns to investors. Now what is ensuring fair returns to the investor actually mean? It says that the shareholders invested capital expecting a reward. Financial management aims to provide regular and reasonable dividends or capital appreciation to keep investors' confidence high and maintain share value. Now we know shareholders are also the owners of the company. Now they invest their capital so that they can expect and return against it, right? You will not invest for something in which you will not get no benefit. They expect some kind of reward or benefit. Now how does this company award them the rewards of the benefits? We have listed over here. It would either provide regular, reasonable dividends or capital appreciation to keep the investors engaged in the business, to keep their confidence high so that they keep on investing in the business or they do not retreat their own money, right? So to ensure that the shareholders will continue investing in the business, they give them regular and reasonable dividends against their capital, or let's say interest on their capital, right? So this was the fourth point. Now before we move on to the next slide, please take a screenshot for your notes. The fifth and the last point over here is minimizing the cost of capital. Raising money isn't free, whether through loans or equity. Financial managers work to structure the capital mix, that is the mix of debt and equity, to ensure the cost of borrowing and raising funds is kept as low as possible. Now, what is this the point minimizing cost of capital trying to say? It says that whenever your money or your source of funds, which is either a debt or a capital, there is some cost is right. So whenever you take a debt, what is the cost of that capital? So what the cost of debt capital is the interest you pay on the debt, and what is the cost of the equity capital? The cost of equity capital is the interest you pay on the capital, right? Interest to the shareholders, the debentures, right? Dividends that you pay to the shareholders is the interest on capital. Now it says that you should keep a mix of the debt and equity such that the cost of capital raised is as low as possible, therefore maximizing the wealth or the profit margin for the owners of the company. So this were all the 5 points inside the secondary objectives. Now with this our topic, the objectives of financial management concludes. So we will move on to the summary. Now what are the summary of the key differences between the profit maximization concept and the wealth maximization concept? So while the profit maximization focuses on short-term income statement approach, wealth maximization takes a holistic view of value creation, balancing risk, time and sustainability to maximize the total market value of the enterprise. Now it concludes that the profit maximization will only view the income earned, right? But the wealth maximization will keep in mind the amount or the value of the business in the market as per their share price. So with this, our topic, the objectives of financial management concludes. Please take a screenshot of the last slide. Thank you for watching this video. Now, if you want the same exact topic in Hindi for better understanding in case you do not understand English, please check out my channel playlist. You will find the same exact topic explained in Hindi by me. Thank you for watching this video. If you like this video, please click on the like. Comment under it how do you like this video. Share it with your friends for their benefit and subscribe my channel for further updates. Thank you.